Welcome to The Explainer. Today, we're diving into an absolute classic of investing, Burton Malkiel's A Random Walk Down Wall Street. This is a book that's been a guide for investors for, well, decades, and its main idea is maybe more important today than it's ever been. So let's jump right in. Right out of the gate, Malkiel hits us with this powerful warning. History is just full of these moments of financial madness, from crazy things like the tulip bulb craze centuries ago, all the way to modern bubbles. And here's the kicker. Nobody is immune. Not you, not me, not the slickest professional on Wall Street. So let's start right there with the problem Malkiel lays out for us. The stock market is often a chaotic, irrational place. It's driven way more by emotion and, groupthink than by any kind of cold, hard logic. The famous economist John Maynard Keynes absolutely nailed this years ago. He said winning in the market wasn't really about picking the best company by reading its financial reports. Nope. He thought it was about guessing what everyone else was going to think was the best company. It's all a game of reading the crowd. And this isn't some abstract ancient history lesson. I mean, just look at the dot-com bubble. You had companies with zero profits, sometimes not even a real business plan, suddenly valued at billions. Remember Pets.com, the one with the sock puppet mascot? It went completely bankrupt. And look at these other tech darlings. Their stocks dropped over 99%. This is exactly what happens when the market psychology just floats away from reality. So, how are you supposed to make sense of all this madness? Well, for decades, Wall Street has basically been a battleground between two totally opposite ideas about how to value stocks and find your way through the noise. On one side, you have what's called the firm foundation theory. This says you should be like a detective, carefully calculating a stock's true inner value. But on the other side, you have the castle in the air theory. This one says, forget the calculator. You need to be a psychologist and figure out what story the crowd is going to fall in love with next. It's a real clash of philosophies. The people who believe in this theory, the legends like Benjamin Graham and Warren Buffett, they're the ones who spend all their time digging through financial statements. They are searching for that rock-solid, firm foundation of value, always hoping to buy a dollar's worth of a great company for, say, 50 cents. But, and this is a huge but, Malkiel points out a massive flaw in this. This whole idea of intrinsic value depends entirely on predicting the future profits, future growth. And as he puts it so bluntly, that's something not even God Almighty can know. Suddenly, that firm foundation starts to look a little shaky, doesn't it? So then you have the other camp, the castle in the air theorists. They pretty much toss the spreadsheets out the window and focus on the story. What's the narrative that's going to grab everyone's attention tomorrow? It doesn't matter what the numbers are today, as long as you can figure out what everyone's going to be hyped about next. This theory basically says that value is completely subjective. A stock isn't worth what its factories and patents are worth. It's worth whatever the next person is willing to pay you for it. It turns the whole thing into a game of psychology, of finding a greater fool. Okay, so if the smartest people in the room can't even agree on whether to be an accountant or a psychologist, where on earth does that leave the rest of us? Well, this is where Malkiel introduces his big and kind of radical idea. Malkiel takes a step back from all this chaos, the bubbles, the crashes, the warring theories, and he asks a really simple, powerful question. What if both sides are missing the point? What if they're both just trying to predict something that's, well, unpredictable? And this is the absolute heart of the book. The random walk theory basically says the market is so incredibly fast and efficient at processing information that by the time you hear about a company's great news, thousands of other people have already acted on it. That good news is already baked into the price. So what moves prices is new news, which by definition is a surprise. It's random. And just look at this. This chart perfectly shows the point. It looks like a real stock chart, doesn't it? You can almost see the uptrend there and maybe a resistance level here. But guess what? It was generated by flipping a coin. It shows that so often the patterns we think we're seeing in the market are just illusions we create out of pure chance. So if the market's movements are basically random, what in the world is the smartest thing to do with your money? If you can't really win the game of prediction, how do you make sure you don't lose? Well, the answer is surprisingly simple. Just let this number sink in for a second. Over the long haul, the data is just overwhelming. The vast majority, in this case over 92%, of professional fund managers, the people getting paid huge salaries to pick stocks, they actually fail to beat a simple market average, like the S&P 500. It's staggering. So if the experts can't beat the average, the most logical move is to just own the average. And you do that at the lowest possible cost. That's the whole idea behind the index fund. You just buy one fund that holds all the stocks in a big market index. It's super cheap, you're instantly diversified, it's tax efficient, and most importantly, it's a strategy that has historically beaten most of the pros.
All right, let's bring all of this home now. Let's see how these ideas can come together to form a real, practical, long-term strategy for building your own wealth.
See, Malkiel doesn't just give us a theory, he gives us a roadmap. It's about understanding the basics, like risk and reward go together, and that time is your best friend in the market. He talks about simple techniques like dollar cost averaging and rebalancing that help you stay disciplined. And maybe the most important one is building a plan that actually fits your life and your financial situation.
And I absolutely love this quote from Warren Buffett because it just completely flips your mindset. If you know you're going to be buying stocks for the next 10, 20, 30 years, then a market crash isn't a disaster. It's a sale. It's a chance to buy more of the world's best companies at a huge discount. That totally changes how you should feel when the market gets scary. And that leaves us with this one big final question. If the simplest, most proven strategy is just to buy and hold a low-cost index fund, why is it so incredibly hard for so many people to just do it? Well, the answer brings us all the way back to the beginning. It's our own psychology. It's the fear, the greed, the urge to follow the herd that Malkiel warned us about. The biggest challenge isn't beating the market, it's beating our own worst impulses.